Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront and generate a consistent return year on year. So the first thing you need to do is open up your brokerage platform. The one that I use is Tasty Trade, and we are of course going to be writing options contracts, so we need to know where we are in the option cycle before we can actually write any contracts. So if we just pull up any underlying, it will bring us this table of expirations, and everything with a orange W is a weekly, everything else is a monthly. For the purpose of this video, we're going to stick to the monthly, or one of the monthlies. The next available monthly is October 18th. We have got a position on the October 18th already. There's 24 days left till expiration. 24 days is a bit short. We like to be around 45 days, so we are going to have to go out to the November 15th expiration, which is 52 days out in time. Now, what we've done now is we've collected this information of our contract being 52 days out. So what we can do is we can go over to our watch list and filter out everything that has earnings over the next 52 days. So now what we are left with is a list of underlyings that do not have earnings over the period of time that we're going to be in this contract. And the reason for why this is because earnings can have a negative effect on your P&L. It can increase volatility, mess up your deltas, etc., etc. Another thing we can do is, which we've already done here, but you can just filter out all of the low liquidity rating stuff. So only 3 and 4 out of 4 star underlyings are listed. So at this point, what we want to do is list everything from high IVR to low IVR. The reason for this is because, of course, we want to sell volatility and play the contraction. And that's basically it. Now you should have a watch list open, right? And you should have it looking something like this. Hopefully yours will be longer than this. We have filtered out quite a lot of stuff. But this is just to show you it doesn't really matter, right? So at the top, we've got JCI with the IV rank of 49.8. We've got Dollar Tree. We've got AMAT. AMAT can be quite nice sometimes. In fact, let's have a look at AMAT. It's trading at $196 right now. It's got 3 out of 4 stars on the liquidity level. An IV rank of 43.6. Let's have a look at AMAT. As we can see here, we've got on November 15th, 52 days out in time. This horizontal orange bar shows you where the price of AMAT currently is. This vertical orange bar shows you the expected move of AMAT over the next 52 days. And so this is called the options chain. So we're going to be writing options contracts, which means we want our contracts to expire worthless. We want them to have no value on them at expiration. So our best chance of that happening is to write some contracts, sell some contracts outside of what the expected move is. So I personally like to sell contracts at somewhere between 16 and 20 delta. So over here we've got 18 delta on the call side at the 230 strike. And we've also got an 18 delta on the put side at the 170 strike. And as we can see here, our strikes are outside of the expected move, and that is going to give us a high probability of profit. And we can see that here we've got a probability of profit of 71%, and there's an 86% chance of hitting 50% of max profit at some point over the length of this trade. So we've got between a 71 and 86% chance of success on this position. Now, if we have a look at the numbers for AMAT, we can collect $640 up front, right? And this position is only going to require just under $2,000 in buying power. So to collect $640 on a naked position, only having to put up $2,000 in buying power, that's a very, very nice return. It's a nice credit that we're collecting here on this position. So if you just mark this on the chart and see what this looks like, 170 and 130. Let's mark it on at 170 and then at 230, sorry. There we go, that'll do. That's near enough. So this will be the range that we would create for ourselves. As we can see, price, the strikes naturally have ended up at recent support and resistance levels. I don't trade off support and resistance levels, but if you do, there you go. Hopefully that means something for you. Volatility is in the process of contracting right now, so hopefully we would be able to see that continue. We have got a pretty wide range. Of course, the position is going to be on for the best part of 2 months, hopefully less, could be longer, but yeah, so this is looking like a decent position. Now, to be honest with you, because of how how much premium you actually collect up front, I don't think that you need to make any adjustments to this. If you did want to put this position on, by all means, just put it on as is. But for whatever reason, if you really wanted to put this position on, but you couldn't quite do it based on the size of your account, and you have maybe a little bit of a smaller account, by all means, you can just come to the next strike down, which is at the 240, $10 wide. Buy that. Make sure it's the same width on the put side as well. So 170, $10 down would be at 160. So we've created a $10 wide spread on both sides that reduces our premium that we collect, but it also significantly reduces the buying power that's required to open that position as well. So trade-offs and probability of profit does drop a little bit as well. So that's what it looks like if you wanted to buy some contracts to cover your shorts and limit your risk. And in essence, that in a nutshell is what it looks like to find a position. Of course, you want to make sure that whatever you're adding to your portfolio isn't going to conflict with whatever you already got in your portfolio. You want to make sure you're nice and diverse. You don't want to be too heavy in any one industry or sector. And you also need to make sure you keep an eye on your position sizing. So we do have a position sizing template. This is very important. If you don't keep an eye on your position sizing, anything else you do won't matter. So the way it works is you enter in the size of your portfolio. Let's say if it's $15,000, you then below that enter in what the current VIX level is. Let's say if it's 19.2. Everything below will then be automatically calculated for you. You then just need to use this information to form the backbone of your portfolio. It will tell you how much buying power to allocate to undefined positions, defined risk positions, and how much of your portfolio you should allocate to short premium in general. You can get this for free. Everybody can get this. Click the link in the description, click free position sizing template, and you can get access to it. If you want to get involved on the trades that we're doing and you want to copy us and make money with us, again, click the link in the description, head on over to EDS Premium and get yourself signed up. And you'll get access to all of our portfolios, not just our small portfolio, but all of them. So there'll always be positions for you to copy. There is a full course inside, so no prior knowledge is required. We will teach you everything you need to know. It allows you to learn and earn at the same time. It is a private community, so you can speak with myself and other like-minded individuals. There's also a 100% money back guarantee. So if you studied our full course and followed our trades for 6 months and haven't seen results, then we will work with you for free until you do, or you can request a full refund. So it's completely risk-free on your part. It's £1 a month right now. The price will be increasing, but once you're in, you don't need to worry about price increases. You are rewarded for getting in early. And with that being said, I will see you guys on the inside.